I want to thank you guys all for joining us. This is being recorded. So one thing I mentioned at the beginning of every single webinar is watch this again. Maybe not necessarily this short call butterfly that I've done, but maybe one of the other ones, because you guys drive the content. Your questions will really bring out a lot of nuances in the specific strategy. And the short call butterfly is something that is a little bit outside of what we normally talk about here at Pro Trader Strategies, where the volatility determining the strategy. And this has some nuances to it with the any call butterfly, the put butterfly, any of the butterfly family basically. Iron butterfly is a little bit different, but the butterflies, the call butterfly, long, short, they act a little bit differently. So you need to pay attention here. And that's another reason why I like to watch it again. So this is the roadmap to trading options on the short call butterfly, like I mentioned, but let me get a couple of things out of the way real quick. My name is Eric Wilkinson. Some of you guys may recognize me as the Wolfman from mainstream media, where I've talked about everything from the economic to geopolitical and market analysis. Started out trading in college with some money I had earned, and after graduating, moved up to Chicago, jumped into the pits and continued my trading career there. So in that time, I've traded everything from stocks, bonds, financial futures, currencies, and options on all these products in just about all market conditions. And one of those things I've learned from trading on the floor is when, where, and why we want to be in a strategy, and when, where, and why we don't want to be in a specific strategy, given anything that's going on around that underlying. Remember, on the floor, I didn't always have a chance or a choice as to what strategies I was putting on. I was a market maker. So sometimes those strategies got executed, and I didn't like this type of environment that this underlying was around, like buying calls in high volatility. That's something that I've learned over the course of my trading career that I'm able to pass on to you guys as those pitfalls that you can avoid that we weren't necessarily able to. And what that's also done is when I get into a strategy that isn't working out, how to stay mechanical with that strategy in order to turn the probabilities in my favor. All right, so what are we going to talk about today? We're going to talk about a couple of things. And some of the most important stuff that we're going to talk about is once we've come up with our directional analysis, right? So we've come up with a direction in the specific underlying. Sorry, let's go back to this. We come up with our direction. And once we've come up with that direction, then what we want to do, so in this case, we believe the market is going to either go higher or lower. We just think that this middle part is out of the question, and maybe we kind of lean towards a bearish assumption. That looks like lean towards a bearish assumption. With the put butterfly, the short put butterfly, we would lean towards the bullish assumption, because ultimately we would like to have our short call in the way that I build it. One of our short calls is going to be in the money. If you aren't building it out the way that I talk about in this webinar, your probabilities of success are going to be much lower. You're going to risk way too much for the potential reward. So that's one of the reasons why I set it up the way that I do, is so that the risk reward is balanced. All right. And I've seen people set these strategies up where they are all out of the money. All the strikes are out of the money, and your probabilities are so low. I've even seen it to where you almost can't even make money on one of those strategies. All right, so then when we talk about the destination, so obviously our directional assumption, we're going to be talking about our directional assumption there. This destination, we need to basically know that we have a tight bid ask. All right, a tight bid ask. All right, and that is in the option montage. So we're going to be talking about that quite a bit here in the beginning. The environment, we're going to be talking about volatility. All right, volatility is one of the most important volatility is one of the most important aspects of any option strategy. That is the thing that really determines what our option strategy is 99% of the time. Now, I say that often, 99% of the time, The reason why I say only 99% of the time, because we're talking about butterflies, and those butterflies, you guys, are the ones that kind of break the mold. We can think of it this way, is that, you know, a caterpillar starts out as a caterpillar, or a caterpillar is a caterpillar, but it morphs into a butterfly. And when it morphs into that butterfly, it changes and kind of breaks the rules of everything else. So not many things can morph. The butterfly can, and that's very well the case here. The duration, we're going to talk about what is the best duration for the short call butterfly, as well as these strikes. Okay, you can go online, they're going to talk about a butterfly, they're going to build it out very similar to what I've talked about, but they aren't going to give you the strike locations, and that is something that I teach specifically in all of my webinars, you guys, is we talk about having that specific strategy. I'm trying to streamline your process in order to get a strategy on and how to take it off so you stay mechanical, all right? So we have specific guidelines that we're going to be following here. But let's get a couple of things behind us. Yes, we are going to be talking about the roadmap key. What is the roadmap key? Well, it's specifically the Greeks, all right? And I hope that I'm not losing all of you guys because I'm starting out with Greeks, but these are some fundamental things that we really need to understand before moving forward with any option strategy. And I think I've got a couple of really quick ways so that you guys will remember it. Delta. Delta is data, all right? It tells us all kinds of things, probabilities. And we'll talk more and more about this throughout the webinar, but specifically what I want to talk about right now is how delta is affects the option premium in relation to that underlying. So we're talking about a dollar move. And all of the Greeks, one thing to get out of the way, all of the Greeks are thinking moving forward, moving higher, advancing, okay? However you want to think about it, it's always progressing forward, all right? Anything moving back or the underlying moves down is a negative to all of the Greeks, all right? So a move down in the underlying is a negative to delta, and we'll talk about volatility and everything else, but specifically when delta is talking about that first dollar move, so let's just call this XYZ. It doesn't matter what the underlying is. This follows through with all of them. So if it goes from 148 to 149.35, right? So $1 move, that's our $1 move. We here will look at delta in this column here and the delta in this column here. Notice that the delta on the put side is all negative, and these should be negative as well. But at the end of the day, delta is negative on the put side. Why? Because as we advance forward or advance higher, well, our put side will lose value, right? As those options go further out of the money, the likelihood that they will go into the money is smaller, and therefore they will lose money as the underlying moves higher. On the other side, the calls, we have that as a positive delta. So that first dollar move, let's talk about it. All right, so we've got a positive delta here. When this dollar move happens, these options corresponding to that 150 call, all right, the 150 call will increase by that 45 cents. So we will then see our options increase by 45 cents. So they would be $4.05 and $4.20 on that first dollar move. On this side, we've got a negative delta, right? That negative delta on that first dollar move will come out of these options. So we could easily see these go to $2.62 on that first dollar move. $2.62 on the bid and $2.72 on the offer. All right? So the delta comes out of those. Now, if we went down by $1, if we went down by a negative dollar, and now we were trading 147 instead of 149, then a negative dollar plus a positive delta makes that a negative delta. So if we move down, then that 45 cents would have come out of the call options, of the 150 call options. And over here on the puts, that negative dollar plus a negative delta makes that a positive delta. So if we move down by $1, then this premium would actually become a positive to those, or the delta, sorry, this negative delta would then be a positive delta and add into the premiums. All right. So the next Greek we're going to talk about is gamma. Easiest way to remember gamma is gamma goes with delta. Gamma goes with delta. So we talked about this being dollar number one. We're talking about now dollar number two. So what happens on dollar number two? Well, we talked about what happened on dollar number one. Now we're at 150.35. So we've moved up now $2, right? Now that's the second dollar. This delta is still in this premium from the first dollar. Now the second dollar, we have gamma. Gamma goes with delta. Right here, I kind of covered it up. Gamma goes with delta over here. So we got that. Now we have 48 cents on that second dollar move that goes into those premiums. So now our premiums would then be looking at $4.53 on the bid and then $4.68 on the offer. All right, so gamma goes with delta on the second dollar. Over here, had we moved up by $2, well, we've got a negative delta plus a positive gamma. Gamma is always positive no matter what side of the chart or what side of the option montage we're looking at. So that second dollar move, we would only lose 35 cents coming out of those. All right. So the 35 cents would come out of there. On the flip side, had we moved down by that second dollar, we know we had a negative 38 delta plus a negative $2 move plus a negative delta makes that a positive delta plus the gamma. We would be looking at 41 cents adding into the premium on a down move. Okay. So they just go back and forth that way. And then we're going to be talking about the thief. The thief in the night that comes and steals our premium is theta. Theta is our thief in the night. Every single day that goes by, it's like theta is a pickpocket coming in and stealing a couple of pennies out of your penny or out of your cookie jar or whatever you want to say. It's the thief in the night that always comes and steals premium. Theta is also more aggressive the closer to expiration we get. Way out in time, it's almost like he doesn't even really know you're there. He's taking a penny or two every night. But more and more, the closer you're getting ready to leave on vacation and lock the doors, that thief is really aggressive. Or once the expiration cycle is ready to go off of the board, that theta thief is trying to take every last penny he can get. All right. Now, one thing we will notice with theta, though, you guys, now we're talking about this column here. Theta on the calls is negative. Well, over here on the puts, guess what? Theta is also negative across the board. All right. That's because we can't go back in time, people, right? Nobody has a DeLorean that we can go back in time with. So theta is always picking away. Now, inside of this 8 days, it really gets aggressive. That's what I was talking about. Way out in time, 100, 200 days out, it's not very aggressive. But inside of this 35 days to expiration is the real sweet spot for theta. That's where he really starts ramping it up and trying to take as much of the premiums as it can. So obviously, tomorrow we come in, all else being equal, the underlying XYZ has not changed. Price has not done anything. The volatility hasn't done anything. Everything remains equal. We're isolating just a 1 day pass, and we would see that 6 cents would come out of these premiums. Now notice the at the monies are a little bit more susceptible to that thief. Further out of the money, we can see, further in the money on the calls, further out of the money on the calls, we can see it's less aggressive. Same goes for on the put side. You can see that these are definitely more aggressive than the ones that are out of the money or deep in the money. So theta, more aggressive at the money. Also, closer to expiration, really aggressive. So I want to get the cogs moving here early on. Get your thinking caps on. When you're trying to take advantage of theta, that would be when you were probably selling premium, right? When you collect a credit, you're selling it, all right? You're collecting a credit so you can buy it back for cheaper, all right? So when you are trying to take advantage of theta, you collect a credit, and that is nearer to expiration, okay? And then we'll talk about Vega. Vega is volatility, all right? Or vol is what I usually call it. I'm not going to be talking about volume. Anytime you hear me say vol, that means volatility. And Vega, believe it or not, is the most important Greek. Well, it's not even a Greek, actually. It's the only one that's not a Greek letter. You're not going to see a hurricane named Vega. Right now, this year, we are doing the Greek hurricanes, right? Naming the hurricanes after a Greek letter. Well, you're not going to see Vega. Yeah, I have a nice V there for Vega as a Greek. That is a Greek letter, but it's actually the lowercase gamma. I just stole it from that to make it look good. And what Vega is, obviously, it's the most important Greek, but not a Greek. It measures the change in volatility in relation to our premium. So when we're looking at this column, Vega, we can see all of these numbers are Vega. It's actually implied volatility, all right? That's one of the most important things we're going to look at, and we can see over here in Vega as well. Notice Vega is always positive, whether it's the call side or the put side. And the reason why is because it's in advance, right? As volatility expands or goes higher, it affects all of the premiums, all right? So on the call side, we'll see those premiums go up, and on the put side, all right? So what we're talking about here is we're going to 27.57. So we've increased by 1 percentage point. Our premiums would then increase by the corresponding Vega, all right? Pretty simple. So that would go up by 19 cents on the calls and 18 cents on those puts. Now, the reason why you might be thinking, okay, that's not much of an increase. Or, if we think about it, if we go down a negative 1 percentage point would make these volatility coefficients negative as well. But volatility has a tendency to move at clips, not just one tick, not just 1 percentage point, but multiple percentage points. So those will add up. You could see an underlying have volatility expand by 10 percentage points. Well, that would be $1.80 in the puts and $1.90 in the calls. That's significant, right? All right. So that Vega increasing makes those premiums more expensive. Now, we could say that when volatility is at its highest, those premiums are at the highest this underlying is seen. Or if 26 was at a very low level, then that would be the cheapest these premiums are. So this number doesn't tell us anything for XYZ because Tesla probably never gets down to a 27% implied volatility, all right? So we need to really isolate this number and dig into what 27 means for XYZ, and that is something we will do going forward in this webinar. All right, so we've got that all out of the way, right? Looks like everybody's on task with the Greeks. Pretty simple. Hopefully you will be able to remember those a little bit easier with some of those things that I said. I don't know. All right, so we're doing this on the short call butterfly. If you were looking at it online, this is exactly what you would get. You got a short call, 2 long calls, or somebody might say you got a short call spread added into a long call spread, and that's how you create a butterfly. Or it's a you would say short 1 call, buy 2 calls, and then sell 1 call, and that's your butterfly. And the reason why it looks like that is because that's how we come up with a butterfly there. All right, so that's what you're going to find online. One thing I want to start out with this webinar is let's take this short call butterfly. We know we're doing it on the short call butterfly, but let's put it up on a shelf for right now and act like we don't know we're doing the short call butterfly. Like we're going through any given day, right? We are going through the charts. We might have an indicator giving us a directional bias, all right? Well, with the short call butterfly, the idea would be that we think that the underlying is currently stuck in a small trend here. Maybe it's kind of going like this, but we expect either a pop to the upside or a drop, all right? A pop or a drop. We're not looking for it to stay within this range right there. We think that that's out of the question, but we are leaning towards the downside. You kind of lean towards the downside. Why? Because the way I set this up, like I said, this short call is going to be in the money, all right? And we would like that short call to go out of the money. That will help us get to our profit margin or our profit target much quicker. It will still work out if the underlying starts rallying for us, all right, and goes to our out of the money short call, right? It'll still work out quite nicely. It's just going to take a little bit longer. So if you are looking at this same scenario, but you're leaning towards the bullish side breakout, then you would be looking at the short call butterfly. All right, so make sure you check out that webinar as well. But in this case, we've come up with an assumption. We don't think the underlying is going to stay right here, but we do believe it's going to break out, and we kind of believe it's going to break out to the downside. All right, so where are we going? What I mean by this is we need to come up with our directional assumptions. So let's just say we're looking at a chart of Coca-Cola. All right, now it's kind of gotten a bit of a breakout here, and this is, you know, a real good example of the reopening trade. Reopening for Coca-Cola, it's going to do very well. It's going to rock it up. The reason why is because Coca-Cola's income is mainly from bars and restaurants, all right? Whereas like Pepsi, a little bit different, it's the snack food aisle. So, and this is causing actually Coca-Cola to rethink some of their business practices. Like they need to start getting involved in the snack food aisle and diversify a little bit more, kind of like what Pepsi's done, because this has really hurt them, this whole lockdown. But having said that, if you believe that the lockdown is going to hurt them a little bit more, like a resurgence of this COVID-19, then you think that Coca-Cola is going to break to the downside. If you think the reopening trade is there, it's going to break to the upside. And that's kind of where I am right now. I'm leaning, though, towards that this lockdown is going to last through the end of the year for the most part, because until we get that vaccine really out to the public, it's still going to be overhanging us, all right? So we believe, or I believe, I should say, I don't want to put words in your mouth, is that it's going to break out of this range and it's not going to trade within that area there. And I am leaning towards it moving back down, let's just say to the point of control, all right? So when we're done, we've got our assumption. You know, I believe bullish is in the question. I believe bearish is the star. So I'm leaning towards this, and I think that neutral is out of the question for this trade. So therefore, with something like this, you know, we could look at doing the long straddle, the long strangle, right, which I did for DIA. But with this one, you can limit some of your risk. The strangle and the straddle, you're paying out a lot of money, and you have to have a little bit bigger move, okay, relatively quickly. With this one, we can kind of sit on it for a little bit. Theta will work in our favor and have that move to the downside. We can get out of this trade much quicker than we probably would with the long straddle or strangle. You need those to really start working out quite nicely. All right, so as the roadmap goes, let's just say we're going on a road trip or something, and you know, we're starting out here. We don't think we're going here. We do think we might, let's say, go to Big Sky, Montana. I think it's right in there. Or we're going to go to Orange County for spring break. So we think we're going to go this way. If there's no snow, then we're going to go for the sun, right? It's kind of how we come up with that, all right? So what we need to find out now is we've got our destination points. We believe that the market is going to go in one direction or the other. Is our underlying a good destination. And what I mean is like, you know, I wouldn't want to go somewhere in like just North Dakota right there where I'm just watching a stoplight blink out of my hotel at a one-horse town or a one-stoplight town, right? I want to go somewhere where there's a lot of things to do. I want to go skiing every day. I want to go tubing if there's a lot of snow. And if there's not a lot of snow, then I want to go somewhere where there's a lot of things to do. I can go surfing. I can go to Disneyland or something like that, you know? So I need to make sure that my points of interest in our destination have a lot of eyeballs on them, all right? Free market price discovery in the options speak is what we would be talking about. So in this case, what I want to do is on a stock that's less than $100, all right? What I want is less than or equal to 10 cents wide on our option montage with the options that are the monthlies. The spot month is what we used to call them on the floor. And that's where the most people would be trading if they are in this underlying. So you can see right here at the money, just out of the money, it follows in line with that rule there. Now we could also take a look at something that's a little bit bigger than, say, $100 stock. So let's take a look at something like Clorox, or Clorox has been a big trader. Yes, I do have a position in here. And Clorox is a little bit wider. So something like this, you can see if I do this according to my rules, what I would want to do is on a stock that is greater than $100, all right, I move my decimal 3 ticks to the left. 1, 2, 3. So that would equal 20 cents, right? So I need to look down here at the option montage over here, a little bit off. You can see it's 30 cents. It's 20 cents there. We got that. It's 15 cents, 10 cents, 10 cents, 30 cents, a little bit wide there, 30 cents, but 10 cents. So in this case, what I do for this is following along with our roadmap key, we could say that if it fits the rule, it's a green light. If it's 2 times the rule, 2 times the rule there, we've got a yellow light. And if it's 3 times the rule, we're looking at a red light. If you're a newer options trader, that's when you kind of say, all right, you know what, I need to figure out something else to do with this underlying, or just pass on trading it in options. So with this, I would say it's pretty much a green light. Maybe a couple of them are leaning towards that yellow, but for all intents and purposes, I would say that Clorox is a pretty good one to trade. So you can do that with just about anything. You can do it probably even, or you can do it with Netflix. It'll work with Netflix. Move it 3 ticks to the left. Let's call it 48 cents. And you'll see that Netflix is fitting that rule. Yes, you can go over here and go volume and open interest. Yes, that's a good way to see that there's a lot of open interest, a lot of volume on any given day. But what I'm trying to do, like I said, is streamline your process in order to find the right strategy, right? We don't want to be clicking on everything. I don't want to be looking all around, doing a bunch of math all the time. I want to be able to look at things and have my quick guide, and that's one of them. Something very easy to look up there and say, move the decimal 3 ticks to the left, 48, 49 cents. That should fit the rule, and it does there, all right? So, first thing we need to do, find out if our destination, meaning our underlying, has a lot of open interest, a lot of free market price discovery going on, all right? All right. So the next thing, the environment. Remember I talked about this is what we are talking about with volatility. All right. So one way to look at it is low volatility. There's no stress, right? When you're driving and you can see for miles and miles, there's no real stress at all. So we could say that when there's low volatility, it's kind of sunny. When there's high volatility, it's snowing, it's inclement weather. You are white knuckling it through this road trip. You want to get there as quickly as possible, right? So when you have high volatility, you want to get there quickly. When there's high volatility, you're thinking lower days to expiration, all right? I want to be close to expiration, around that 35 days to expiration. Low volatility, you're thinking I want a lot of time to get there on this road trip. So you're going to stop and see all the sights, right? Well, that's what we usually talk about. We're talking about a butterfly here, though. And we can see here with this one, we could draw lines in the sand and see where this current volatility is. Remember, we were talking about this number on the option montage, 24. It was 26 on the option montage, but it's 24 on the chart here. So that's that point of interest. Now, what we usually see with underlyings is they usually have a tendency to want to stay within a certain trading range, all right? So, or a certain range for volatility is really what it is. So when we're looking at this, we can see that it wants to stay within a certain range here, and therefore it doesn't usually break out too much. Now, one thing to note is this event here is a black swan event, and it happened across the board in all the underlyings, right? When VIX shot up like it did, it's determining, or it's telling you what the overall market is feeling. This implied volatility tells you what this specific underlying is feeling. And this type of volatility spikes that we've seen across the board hasn't happened since 1984, all right? And then before that, 1929. We didn't even see this kind of volatility spiking happen during the last Great Recession, all right? So this is unprecedented. Something I like to say is we might want to discount that data. I also don't think that we're going to probably see the type of low volatility we saw back in 2019. Why am I saying that? Because we don't have a cure. We still are seeing the economy struggle, right? If we have more lockdowns, that's going to cause more pain. That's going to keep volatility elevated for me for the foreseeable future anyway, at least until the end of the year. And I think we're probably going to see volatility elevated at these levels through 2021. All right. So what we used to say with the VIX being the teens, the high teens being high for the VIX, well, 20s are the new teens. All right. So 20s and 30s are the new teens for the VIX. I'm not talking about this particular underlying volatility coefficient, but what I'm saying is the VIX in general. So that is what we're talking about, the environment. We need to figure out where this current implied volatility is in relation to where the underlying is. So right now we could say that Coca-Cola has medium to low volatility, which is the sweet spot for volatility when we're implementing a short call butterfly. We want volatility, implied volatility percent specifically, and I'm going to go into this, between 15 basically and 30%, all right? Usually I say high volatility is above 50, low volatility is pretty much below 50, but really low volatility is below 15. That's really low volatility. This is kind of a medium-ish volatility when we get in this area here, all right? So that's what we're looking for. And why does volatility matter? Because when volatility goes up, our premiums go up, right? And when we have paid for, debited to buy an option strategy or an option, then we want volatility to expand. Why? Because if the underlying doesn't move and that volatility expands, we are becoming profitable, right? And when volatility goes out of it, we could see ourselves losing money, all right? So when we're setting up these strategies, it's very important to understand where implied volatility percent is for that underlying. Or another way to say it, where implied volatility is in relation to where this underlying has seen implied volatility in the past. Because we know that implied volatility has a tendency to stay in a relatively decent range, okay? It will break out above and below that area, don't get me wrong, but it has a tendency to also want to migrate back to the middle, all right, which is about an IV percent of about 50, right? Well, that would be the middle or the mean. So this would be low volatility, high volatility, and we expect it to revert back to the mean. So in that case, your expectation of volatility to expand. Now, generally speaking, we're talking about with a credit strategy, right, which is the short call butterfly. That's one of the indicators. Short call butterfly is that we're going to be collecting a credit. But believe it or not, this is where the butterflies break the rules. We want volatility to expand. Why do we want volatility to expand with this strategy? Well, because the two short calls are going to be far enough away from the at the money volatility effects. We already talked about this. The at the money is a little bit more than the out of the monies, right? So the ones that we're buying are the ones that are closer to at the money. So that volatility expansion will help this strategy, okay? Because the ones that we're buying will expand faster or increase, the premiums will increase faster than the ones that are further away, the one that is deep in the money and the one that is deep out of the money. All right. So normally what we're talking about when volatility is high, we're selling premium. Well, we're doing a butterfly, right? We're collecting a credit. We want volatility high. No, with this one, we actually want the volatility low and have that expand like we talked about here, because those at the monies are the ones that are going to be affected more so than the out of the monies. So let's dig into the implied volatility and figure out where implied volatility currently is in relation to where it's been in the past. How do we can look at it? One of the quick ways to look at it would be say, all right, well, let's just take out some of the other aspects, draw a line there, and then say that the low is probably, that's a little bit low, but somewhere around there, right? So the general high would be here, general low would be there, and we are currently, looks like we are low to medium in volatility, if we'd say that this is the mid-range, kind of, all right? So expectations of volatility starting to go higher would be something that would help us out in this strategy. So let's dig into this. If you guys are really into digging into the math, I've got a couple of ways to streamline your process, so don't get too far away if you guys don't like this. But what we do is we look at current, right? Current implied volatility, IV, which is implied volatility. This is IV, right? Current IV minus the low IV. All right, we take that sum and we divide it by the high IV minus the low IV. All right? And really what this is doing is telling us where the current IV is in relation to the high and the low. So if we don't take out the old stuff that we saw in the past, listen to Tosh, you guys, is the platform I normally use. It gives us implied volatility percent. It takes into account all of that stuff I told you I think probably should come out of it. But just to do the math the way that they've done, we could say that this is 90. So we've got the high. The low, we're going to say, is 12, right? So we've got this point as 12, and this is 90, and we see where the current is, right? So the current, we've got 24. I'm just going to round it for math. Minus the 12. Take that sum and divide it by the 90 minus the 12, right? So we've got 12 divided by 78. All right, so 12 divided by 78 is right around 14 and a half, 14.57, okay? And that's what TOS is giving us. Now, if we take the reason why this is important to understand, because if I take this out of the equation and I say that this is the high, right? 41 is the high. The low is right here. We're going to call that 20, all right? And we got 41 as the high there. Now we would look at it this way. We've got 24 minus 20. Take that divided by 41 minus 20. So we've got 4 divided by 21 which is right around 20%, just slightly less than that. So we'll call it 19%. All right. So 19%. That fits in my rules. You know, this one actually fits there too. What did I say? 15 to 30, right? That's what we're looking for. So implied volatility percent determines, this tells us that that current implied volatility is in the lower 20 percentile, right? Which means that premiums, if volatility is one of the major determining factors of options premiums, yes, we can say that it's time decay also, but that's something that is eroding. This is something that will, the theta, sorry, is eroding away at those premiums, and it does increase the closer to expiration. But what the implied volatility will have a tendency to do is adjust quite dramatically at any given time. So this is going to affect our premiums throughout the duration of this underlying option contract, all right? Positively and negatively. As it goes up, it's going to increase those premiums. As it goes down, throughout time, all right? So we need to know before we get into this strategy, actually we need to know what this is before determining what strategy we're going to do, right? We're still on this roadmap. We've gotten our directional assumption. We know we've got a good underlying. Now we're following through with finding the right strategy for our assumption. And what we need to do first is find out where implied volatility percent is for this underlying in order to determine the option strategy, right? So right now we know that we've got medium to low volatility based on our implied volatility percent. So what kind of duration are we looking at? Now we're starting to lean towards, we've got medium to low volatility. We expect volatility to maybe expand. I think this underlying is going to move to the downside. That volatility expansion will help me. So the duration I want to use for the short call butterfly is actually relatively short term, because remember, the ones that we're looking at the most in this, even though it's a short call butterfly, we're collecting a credit. The thing that really drives this strategy is the at the money calls that we're buying, right? So that's why we want medium to low volatility. We want that volatility to expand. It affects those option strategies we're buying. And the duration, we want a little bit shorter time, because when we collect a credit, right? If we collect a credit and we don't get that volatility expansion, then as the erosion happens, those out of the monies, or those our short strikes are going to decay, and that will help us get out of this strategy quickly. All right. So we know what our duration is. We're going to go short term. We're going to beeline. It, right? We're going to take off and try and get there as quickly as we can. We don't want to stop and see any roadside attractions. All right. So when selling an option, a trader wants to exploit theta. All right. So basically what I'm saying here, when you collect a credit, that means that you want to exploit theta. All right. And we are collecting a credit with this option strategy. So when you are collecting a credit, we can see that this is the at the monies, right? It affects all of them, though, about the same. Yes, the curve will be slightly different. You can see out here, it's going to hold on to theta decay inside of 35 days. It really starts ramping up. So that's what we're going to be looking for the iron butterfly, because believe it or not, theta decay will help us because we collected a credit. So what strategy are we going to use, you guys? Yeah, we kind of mentioned it. This is basically where we're taking it off the shelf and looking at the short call butterfly, right? So what spots are we going to visit? We're going to, I'm going to tell you a little bit more than just the short call. We're going to talk about, at the monies, we're going to use the 50s, right? But where do we define this risk? Now, what I usually say here is we're looking at, if this is the at the monies, all right? If it's a $50 stock on the at the monies, I'm looking at 10% move. So a $50 stock, these would be $5 away from those at the monies. All right, $100 stock, we're going to be looking at about $10 away. All right. The other thing that you could look at is when you're looking at the premium that you have to pay when you're building the strategy out, like these two here, whatever that premium is, all right, you're going to look to double that, and that would tell you where the wings are. And I'll show you that as we build this thing out. So a real quick example of this, back to this Coca-Cola, right? I am buying two of these options, buying two here, right? So one thing to think about this is I've got a $50 stock. I'm going $5 wide. You can see that that's what I've done down here in the option montage down there. I went $5 wide based on that 10% rule. Easy way to figure that out. The other thing that you could look at is, you know, you're looking at when you buy these, you collected $2.20, right? Because you paid $2.40, sorry, because you double that, right? Buy one, it's $1.20. I buy two, that's $2.40. Well, times two, that puts you around that $5 mark. All right. So all of those things kind of check it off. Easy way to fill out the butterfly. I don't go up here and click on the butterfly. I don't always like the strikes that they give, and it feels like I have to build it out anyway. I much rather pull up the option montage and build this out from scratch. And by doing that, what I would normally do is, let's just take a look at this Coca-Cola example again and delete. I have it in there from yesterday. So basically what I do is I buy that one, right? Hold down on the control, click it again, it doubles it. So I've got, I'm paying really $2.50 here, double that, $5 wide, or however you want to think about it. And those are the ones I want to sell. All right, so selling that one. Another way to also look at this is you're usually defining, or those short strikes are usually going to be about a 90 delta in the money and about a 10 delta out of the money, which is what we talked about in that one slide previous here, right? So the 90, it's another way to look at it, the 90 delta, the 10 delta-ish, all right? So those are several ways to think about it. I usually find that the 10% idea is going to get me to that 90 delta rather quickly, but you can look at it in all those different ways, 90-ish delta. But ultimately, when we build this out, we want to make sure that we're going to receive a credit. We want to make sure that we are going to risk $1 to make $1. All right. That is at a minimum, right? So in our example here, we can see it's $5 wide, $3. So, it's not 50-50, right? It's like 60-40. So a little bit better. I can make a little bit more than I'm able to lose, because I make $3, could lose $2, right? So it fits that rule, all right? That is a definite green light. You're right there at the 50-50 or slightly, maybe I was paying $2.45, or I was collecting $2.45, let's say. I collected $2.45. That means I'm able to lose $2.55. That would be right around that yellow light. Very close to 50-50, but starting to lean towards yellow, all right? And the reason why is because we want it to set up like this, where we are risking less than we are able to make, all right? If we were to look at another example of, say, let me see if I can find my chart here. Let's see if this pulls up. That's not what I want. A risk disclaimer. That's not what I want. I want the snapshot. Did I pull this up? Right here. Oh, this is the example of the out of the money. So this is where I was talking about, where you could make it build out where you are able to make 50 cents and lose $10. All right. So basically building out that's a broken wing, but building it out so you can't make money I've seen people say for a directional move, they try and place those there. I don't like that at all. I'd rather have a different strategy on for something like that. So let's take a look at, I think I was looking at the other day. So what if we did it with really high implied volatility? All right. So let's look at Zoom. So Zoom, $400 stock, 44 cents to the bid offer. This one's a little bit outside of that, as you can see. So we'd have to say that it is close to a yellow light. But let's just take a look at it with really high implied volatility, what this strategy would look like. So I'm going to buy two of these at the monies, right? Got those on there. 41. So basically, I'm looking at going out at least probably closer to $80 with this, right? Because I've got to multiply that by 2, at least $80 out. Let's just start looking at the 90 delta. That puts us at about, let's look at $100 and see what happens, because I don't think it's going to even work here. $100 down, $100 to the upside, or that's 110 to the downside. So let's just go 110 to the upside. So we're looking at 560 to sell. All right, so we've got a credit of $41, not quite making our strategy work out because we have $110. Let's move these strikes out just a little bit more. I'm just going to start over. So let's go 120 out. Oops, sorry. And add one more to that. So we're looking at 560 to the upside to sell. And 320 to the downside. It's getting us closer to that delta. And it's still risking less, right? That's still a yellow light, maybe even teetering on a red light. So you're going to have to play around with those a little bit to get that. But the problem here is you can see that when you're building this strategy out in high implied volatility, these premiums that are at the money are really inflated, all right? Which means that when I'm paying a debit, right, I have to go deeper in the money in order to get it to fit my rules, which means that it could hurt me. If that volatility comes out and these are affected more, it's going to make these premiums worth less, right? And that's going to hurt me, as these aren't going to decrease as much. You can see the Vega is at the monies is 50 cents. These are only 19 cents. These are only about 30 cents or something. So it's going to be negatively affected here more than these deeper in the monies or out of the monies. All right. Does that make sense for everybody so far? We can take a look at the what this looks like on, oh, sorry, I want to go the other way. What it looks like on the Analyze tab as well. Let's analyze this trade, and we'll see that it is like an iceberg where more of the bottom of this iceberg is deeper in the money. You can see that we could lose up to $7,000 on the downside and only make $5,000 on the upside with this one. All right, so we're risking more than we can make, and that makes it more of like an iceberg. All right, so that's why we want to stay away from something in high volatility. It makes it very difficult to risk one to make one. You want to get into low volatility because the premium I'm paying for these 52.5 calls is much less, right? So I don't have to go as deep in the money. All right, so we've got this, right? Directional assumption. We have a breakout scenario. We're going to either pop or we're going to drop, but we're leaning towards the drop. And that's the reason why we lean towards the short call butterfly. If we were leaning towards a pop, we would lean towards the short put butterfly. But we are leaning towards the bearish side in Coca-Cola. So we have our directional assumption. That's the first thing we come up with. Now we need to go down this roadmap in order to find the right strategy. First, we need to find out, is our destination, is our underlying, is is XYZ a good underlying? Right? So we determine that by less than $100 stock, right? It's less than or equal to 10 cents. Or if it's greater than $100, we do the decimal 3 ticks to the left, right? And then that equals what it should be, right? So for instance, a $200 stock would be like 20 cents. Environment, we want medium to low volatility, or we have medium to low implied volatility percent for that specific underlying. The duration, we want 35 days to expiration. Why? Because we talked about it. We want that theta decay because we collected a credit. That will help us out. Anytime you collect a credit, you want theta on your side. And check, we've got our strikes, and that is basically, you can look at it the 10% rule, or you can look at it as the double the debit, all right? All of those things will follow along. All right, so our max profit is always the premium received. Anytime you collect a credit, despite the fact that this is an oddball strategy, you collect a credit, that's the most you can make. And we'll go back to the option montage here, or the option thing in a second. I'll show you how this works out on the Analyze tab. Max loss is basically what we're looking at is, I use the out the monies just so that you don't have a negative number, right? So it's the width. So we're looking at the width of the spread, all right, between the out of the monies to the at the monies minus the premium. So in our example, we collected a credit of $3, right? So we were using the 47.5s, the 52.5s, and the 57.5s, right? The width from 42.5 to 57.5 is $5. Premium was $3. So our max loss is the $2, all right? We have 2 break evens. Why? Because the market can't go in both directions at the same time. So our out of the money, and this is another reason why you would be leaning towards this strategy versus the long strangle, the long straddle, right? The long strangle, long straddle, you expect a huge move. Well, this one, we expect a big move to happen, but maybe not as confident, right? So we want to limit some of this. This will bring our break evens in a little bit. So our out of the money call minus our premium. So that out of the money strike minus the premium is our break even to the upside. And the in the money call plus the premium is our break even to the downside. So if we look at the Analyze tab, we can see that show up right here. This is our break even. We can see this line right there. That's a break even. That's a break even. We look down at our 57.5 calls, which are the ones that are out of the money. 57.5 calls minus the $3.03 puts us at basically right there at $54.50. On the downside, we're looking at the 47.5 plus the $3 puts us at $50.50, right? You know, yes, there's a couple pennies there, but that's what we're talking about. And then our max profit is when the underlying breaks out to the upside or the downside, right? And that is once our short call, out of the money short call, and our out of the money or in the money short call are breached. That's when you close this straight, okay? You get clipped on the downside. This underlying Coca-Cola goes down to 47.5. As soon as that trade happens, that's one of our exit strategies, or it goes up to 57.5. That is when we're looking to get out. So one of the things we always talk about here at Pro Trader Strategies is know your exit strategy before ever entering your trade. All right, so we need to go over this. One of the things I'm looking at is my credit decreases by 50%. All right, that's when I'm looking to get out. All right, I don't want to be in this strategy forever. I'm looking to get out at 50% of max profit. So this is the short call fly, right? We're taking the short call fly. 257.5, we're out, or 47.5, we are out. So if KO goes to either one of those strikes, that's where we're looking to exit this strategy. On a winner, we're looking at 50% of max profit, which is that credit we received. On a loss, for me, it's defined risk. I'm going to try and hold on to this strategy. You guys see what I'm doing in DIA, right? I have a long strangle in there. It hasn't been working out, but I know what my risk is getting into this strategy. I know what my reward is. This could pop in the last couple of days also. It's not unheard of to see that markets start to move in the last few days, and you could really see this start to happen. I am not going to take this into expiration, though. I would try and cover it for anything I can at expiration, all right? I don't want to go into expiration, especially because I've got that short call that could be in the money. And if this isn't working out, that short call is probably in the money. All right? I don't want to have all this stuff offsetting in my account. I'll just cover the trade then. So that's one of the times that I will cover it early, is I'm not taking it into expiration. All right. All right. So that's it for this strategy. Pretty simple. If you have any questions, comments, or anything else, please reach out to us. Oh, one last thing. I've got an offer for you all out there. If you guys are watching this, you guys can take advantage of this. I don't have a hot link for it, but this is a time you could pause this. I've got this thrown over in the chat window right now for you guys. So go ahead, click on that chat window link. It will bring up a web page for you, which is the only hot link I have. It will allow you to have access to my entire course over the last 5 years, all of the videos I've done. So you can check those off. Like I said, watch another short call butterfly video from one of the different courses, because in those courses I'm designing them just a little bit different. Some of them I'm designing for newbies and stuff like that, where we talk about different nuances. Plus, you guys are driving the content. You guys make it a lot more interesting. You get full access to hundreds of hours. It's hundreds and hundreds of hours. Also, we're also down to about 25. We're only going to limit this. Why? Because this is a heavy lift, you guys. I love all your guys' questions, but it's time consuming. So we got to limit the number of people that can come into this program because of the question and answer. Unlimited. I have unlimited. You guys have unlimited access to me. And this says during office hours. I have a guy that's over in Japan, and I break outside of the office hours. Why? Because I know if you guys have a question, you guys want that answered quickly. So I want to make sure that you guys are clear of concept before moving on. If I can't answer it in an email, hey, we'll pick up a Zoom call. We'll do screen shares, all of that stuff. You also get free upgrades to all of the promotions, the future content we have, lab events, VIP invitations, discounts, everything else on all kinds of goodies, and a whole lot more, you guys. I don't even have enough time to go into everything that we're offering you. And it's for $97 a month, but here, we're going to give it to you guys. If you guys pay for 1 year, and yes, we can put you on a payment thing. For 1 year, if you commit, we'll do it for $495. All right, $495, and talk to the guys at Pro Trader Strategies to get you guys access to that. So give us a call, 310-598-6677, or email me at trading@protraderstrategies.com. Again, there's the link that you guys can hot link to. So, if you guys have ideas for future content that you guys want me to do, reach out to us, talk to us. We'd love to hear from you. All right, one last thing. We already did the disclaimer once. Take a moment to go over this. Pause the video if you have to, but there are risks to trading, and you guys should know those inherent risks. All right, that's all I got for you. Other than one last thing, if you can't take that, take it easy. Thank you, guys. Thank you for the kind words. Appreciate it. Take care for now. Bye.